Hello, everyone, and welcome to today's edition of the 7 Investing Podcast, where it's our mission to empower you to invest in your future. You can learn more about our long-term investing approach and see all of our stock market recommendations at 7investing.com and get started with your very first week, a full test drive of everything we have to offer for absolutely free. My name is Simon Erickson. I'm the longtime host of the 7 Investing Podcast. Ladies and gentlemen, we have a true treat today. We have an excellent guest on the program. John Maxfield is one of the most respected opinions in the world when it comes to banking. We're going to chat a little bit about banking on the show here today. But first and foremost, John, real pleasure to have you on the show. Thanks for joining me on the 7 Investing Podcast.
Simon, it is a pleasure, my man. You and I go, your viewers don't know this, but you and I go a long way back. And so it is an honor to kind of like reconnect,
It sure is, and we've got some fun stuff to talk about for the show today. We're going to talk a little bit about, Trump's new election, what that might mean for banking regulations. We're going to talk about rates coming down. The Fed just cut rates again, what that's going to mean. We're going to talk about SoFi, which is an individually tradable stock that's related to banking. But first, John, man, since I've got you on the show, and like I said, respected opinion about banking, I know you have researched a lot about this. You've got a background in banking. You've done some deep dive studies on this. Maybe I just open this up with an open-ended question of what is it that investors should know about banking and your thoughts on the industry?
Okay, that's a great question to start with. Okay, so here's the thing about banking. And this is actually a really fundamental point that I'm glad, like this is the exact right place to start because it'll set everything up. The thing about, you can look at banking in two different ways. You can look at banking as just another business. And like the supply and the demand dynamics in banking, you would assume would be the same as any other business. It's just that as opposed to selling shoes and cars, banks just sell money by making loans, right? And so you can think about it that way. Or you can think about it in its true form, which is that the supply and demand dynamics in banking are actually the opposite the supply and demand dynamics in other industries. What I mean by that is, let's say you're a bookstore, right? And you want to increase sales, right? Well, how do you increase sales? Well, you cut the price of the books, right? Well, let's say you cut the price of books down to $1. Let's use a different example because not everybody loves books like we do, Simon. I love nice shoes, okay? Like I love nice shoes. And so I buy as many shoes as my wife will absolutely allow, okay? And so if they drop the price of shoes to $1, I would buy a lot of shoes. Let's say I would buy 100 pairs, right? That's a lot of shoes. But that's only 100 pairs. And like the same thing with like a Mercedes. Let's say they drop the price of Mercedes down to $1. How many Mercedes would you buy? I would buy 5 Mercedes. That costs $5. I wouldn't buy 50 Mercedes, right? So you have this, that's the demand dynamic in your typical business. Banking, it's completely opposite. The demand for credit is infinite. If you drop the terms and the price of loans just a little bit, and you ease up the terms just a little bit, you can attract an enormous amount of demand for your loans. And so it's almost like an infinite amount of demand. And you can think about it like this. Let's say they go to you, a bank goes to you one day, Simon, and says, Simon, we think you are such a stellar creditworthy individual that we are willing to make you a loan at whatever amount you would like. It will always be at an interest rate 100 basis points below the prevailing rate. It's non-recourse. So if you default on it, we're not going to come after you personally. And it has an indefinite duration. How much money would you want, Simon?
Bring it on. Let's load it up. Back up the truck.
All the money.
Mm-hmm.
Give me all the money. Do you know what I mean? So one person can come into banking and totally jack up that demand, right? So that's a different supply and demand dynamic. And here's where it matters, okay? A bank CEO can grow a bank as fast as he or she wants, okay? Because of this infinite demand dynamic. And the other thing is that because you don't know when a loan is good until it's paid back, for all these years, banks sit on these portfolios that they don't know how are going to perform, okay? And so what that allows you to do as a bank CEO is it allows you to grow really, really fast and increase your compensation also really, really fast in the short term. But then the problem is that because banks use so much leverage and there's so little margin for error, those decisions that they make to grow at an artificially fast rate, and this is perfect for what we're going to talk about later, those decisions oftentimes lead to catastrophic failure in banking because the margin for error is so small. So the long story short, this is the best way to think about banking. A typical business operates on planet Earth. where all of its energy must be exerted trying to grow, to get up off the ground, right? All the energy. Banks operate on the moon, where their energy has to be exerted to stay on the ground, to stay on the ground. And if you can conceptualize how significant those two things are, that is the key to understanding banking.
That's the perfect setup for where we're going to go with a lot of this program. Thank you, John. Thank you for the perfect 10,000-foot overview. Before we get into some of those more specifics, though, I did want to ask you a question about the banking cycle. And I know that you and I in our prep call, I believe you had told me that you spent 18 hours a day, every single day for 365 days, just looking at the history of banks and, how they operate and what the cycle looks like. Can you tell me about what you've learned about the banking cycle and what it tends to look like?
Yes, I can. Okay, so
Was that correct, by the way? Did I have that right about 18 hours?
This is a really good question. Okay, so if you look, so there's an invisible scaffolding behind every subject matter. Okay, it doesn't matter what subject matter you're studying. Okay, and you have to learn that scaffolding to master the subject matter. Okay, part of that scaffolding, this invisible scaffolding that's behind a subject matter you want to intellectually master, is a thing called periodization. Periodization is a thing where you're just breaking a historical subject matter down into eras, like the Roman Empire era, like the Greek Empire era. You know what I mean? Like you're breaking it into eras, and you're doing that to simplify it. So then you can take all this, you can sort all this data and take it in and actually make it usable. Do you know what I mean? And so when the scholars, I went through and I looked how the scholars had lined it up, and the periodization in this context would line up with cycles, right? A proper periodization captures a full mega cycle. And there's little cycles within a mega cycle, but a proper periodization, each era will cover a full cycle. Well, I brought these data sets all the way back to the beginning of the country. And then I compared the data sets and the movements in these curves, the seminal data sets. So like bank creation, bank failure, bank population, bank profitability, those things. And I compared all those data sets, go all the way back to the beginning of the country. They took like thousands of hours to aggregate these, by the way. And then I compared that to the periodization, to basically what the scholars were saying causes the big shifts in shapes in the curves. And you put those two things up against each other and you realize, oh my God, they don't match. The data is not agreeing with the scholars. And so what you realize is that, because what the scholars were telling us is what the periods, the cycles were caused by the comings or goings of a central bank-like authority, because that's what influences the money supply, right? But when you actually look at it, what you realize is that the big shifts and shapes and shifts in the curve are caused by what I call novel liquidity flows. And that's when an enormous amount of liquidity comes into a system and knocks it out of equilibrium. And that liquidity can come in from two different ways. It can come through the ground, money creation, Federal Reserve, or it can come from another system, i.e. Europe, okay? And so what I realized is that once you then line up these cycles correctly, that allows you to have a better sense for where you are at any particular point in time. Let me give you an example. So the cycle that ended in the financial crisis began in 1973, okay, with an oil crisis that caused inflation, all these monetary disturbances that then led into to the financial crisis of 2008, and then kind of the cycle kind of really completed in 2010. And so everybody's sitting around saying, well, are we in a new era? Are we in an old era? Are we in purgatory? And then what happens? COVID strikes. And what happens in COVID? An enormous inflow of novel liquidity. So what that tells us, and then the other thing we know about this is that every time there are these novel liquidity surges, almost immediately preceding those or following those are what I call liquidity destruction events. There's two types of liquidity destruction events that are particularly effective. Number one is a bank failure. Number two is a stock market crash. And so what did we see in 2020? All the money comes in, it sits there, it goes to these banks, and then what happens? We have a few of them explode. And so it's like, what it allows you to do is you're like, okay, we know we're at the top of a cycle. We're at the very beginning of an era that could last for 50 years, could last for 70 years, could last for 40 years. But that's where we're at now. And that's what allows us, the research allows us to know.
That was a fantastic background, John. Thank you for that. Let's talk a little about where we stand here in 2024, maybe 2025, right? Because like you mentioned, we've seen some of those. We've seen some novel liquidity events. I would say zero interest rate environment, then COVID, money's free. Let's go out in there, let's borrow money. Followed by, a stock market meltdown. It was certainly a very bad year for stocks in 2022. And we saw the Fed, raise the Fed funds rates 550 basis points in a single calendar year. Where do we stand in this cycle in the bigger picture? Is this a shock that's that's really a big impact in the last couple of years, or is this kind of normal of how you kind of see things going up and down, and where do we stand in the cycle in 2024?
This is all, if you take all the cycles into consideration, this is not unusual. You know what I mean? We're just kind of at this place in the cycle, okay? And we're at the beginning. And so when all that novel liquidity flows in, that money flows into certain banks and it burns a hole in their pocket because they're sitting there paying interest on it. And so they want to earn a yield on it. And so then they go out and do ridiculous things with their asset portfolio to earn that yield. You know what I mean? So where we're at right now is kind of I would say that the two most important things to kind of take into consideration at any particular point in time for banking is, number one, the interest rate environment, and then number two, the credit environment. So let's take those piece by piece. So the interest rate environment, obviously we've been through like turmoil in interest rates over the past few years, right? We dropped them down to zeros. All those banks loaded up with securities on their balance sheet. The Fed jacks up rates 550 basis points over the course of 12 months. It decimates banks' balance sheets, okay? So we have a lot of banks that are still sitting out there with these undervalued securities that declined in value when interest rates come up. So you have a lot of that going on. In the asset portfolio, in terms of the loans, however, the loans seem to be, by and large, and here's the important thing to realize. You'll listen to a bank conference call and they'll talk about, oh, our credit is pristine. You know what I mean? The reality is that credit is never pristine. It is always TBD. Okay. You don't know, a loan isn't good until it's paid back. Right. And at that point, once it's paid back, it's not factored into the analysis for the quality of your portfolio. Do you know what I mean? And so, but the credit quality right now seems to be good. And I say that for two reasons. Well, first of all, I mean, I talk to all these people all the time, but and of course, but they're never going to tell you their credit is bad, right? So you kind of like, if they tell you it's good, you just take it with a grain of salt anyways. You know what I mean? But the reality is that they just lived through the financial crisis. Yeah. These people don't want to live through it again. So they've like restricted themselves in terms of like the risk taking. The regulators have come in really hard over the last decade. You know what I mean? And it's just like, there's like still trillions of dollars in dry powder on the sidelines that will come in anytime any of these asset values fall very far. And the principal asset values that banks are concerned about are real estate. And that stuff comes down very far. You'll have institutional investors who need to put that money to work. That'll kind of provide this is my analysis, just provide a support to the economy just because there's so much of that liquidity. So that's kind of where we're at right now.
And how about the part of the regulators? You know, they've been coming in hard the last decade, like you mentioned. We do have a new presidential election. Trump has just won. He's kind of already promised, ease in regulations, making it easier for the lending environment. Is this generally favorable for banks? Are you hearing anything from banks out there coming into 2025?
Not only is this favorable for banks, and I'm not a political person. Okay. I'm just not a political animal. Okay. So like when I say this, I'm not saying this for political purposes. I'm saying this as a scholar of banking. Okay. That's the exclusive context for this. The regulatory environment has gotten so strict over the past decade and a half that it is strangling innovation and growth in this country. That is what I believe from the perspective of the bankers. Let me give you a specific example. New bank formation has declined in recent, if you look up going into the financial crisis, we'd have 150, 200 banks or something like that a year of being founded. There are like literally no banks being founded now. I mean, there's like one or two here and there, but it's like there's literally no banks being founded right now. And one of the problems is that the reason they're not being founded right now is that I can't remember if this was in Dodd-Frank or it just came about at the same time, because this is just a regulatory move. But they increased the capital requirements to founding a new bank to $25 million. And when you have this regulatory stuff where you have to, one of my good buddies runs, I don't want to say the bank, but a very, very, very good bank. Okay. And he had in his AML BSA team, so Asset and Liability Management or Bank Secrecy Act and Know Your Customer. They had like a couple people in there like a decade ago. They have like 150 now.
Wow. Yeah.
And so like you can see how like it is almost impossible to earn your cost of capital in that type of environment where so much of your money has to be spent on just policing yourself. Do you know what I mean? And so like that, and Trump, he'll come in, they will ease them. And that will be a welcome relief to the banking industry. But it should be a welcome relief to everybody. It's just gotten too tight.
Well, I want to talk about one of the outliers here, John. This is going to be a fun conversation because when I first came to you and I said, hey, I really want to have you on the podcast, there was one stock that I really wanted to pick your brain about, and that's the one we're going to talk about, which is SoFi. And for those who are not yet familiar with SoFi, this is a financial technology company that has now become a chartered bank, right? So it gets its banking charter back in 2022. Tough time to be a bank, right? Doesn't raise a whole lot of money, but it's kind of been sitting in limbo for a couple of years. But its growth has been incredibly quick. And for those that are unfamiliar, this is a popular app. It kind of started with student loan refinancing. You get a lower rate for a student loan that you might have had, a personal loan if you wanted to borrow money and you were just a personal, not an institution. And then now it's expanding into mortgages and other things. It wants to be kind of the one-stop shop for all of your banking needs for your whole life. What bank doesn't want to be that, of course, but this is one that, has really capitalized on the digital trends. Very low acquisition costs, very, very fast growth in terms of members and all the other things. Just to give a couple statistics to make this kind of real, the number of members, this is the number of people that we're working, have a lending or a borrowing relationship with SoFi, has grown from 1 million people in 2020 during COVID to about 9.4 million people here in the most recent quarter, right? 9 million people within 4 years. And it's also adding almost 750,000 more accounts every quarter now. And then the number of products too. This is lending products. This is not exactly the same as members. Members can have more than one product, but say you have a student loan product, you want to have a personal credit product, things like this. Grown from 1.3 million in 2020 to 13.6 million in 2024. So these are growing very, very fast, John. It almost bucks the trend of what you just said, that there's been a lot more regulations. It's been harder to get people to join. SoFi has done it incredibly, really quickly. Maybe let's first open Pandora's box of this conversation to talk about, it seems to me like this growth is phenomenally fast. Do you agree with that statement? And do you think there's anything that SoFi is specifically doing right to attract so many assets to its platform?
Well, anybody can attract people to borrow money, and anybody can attract people to deposit money. That's all based upon what you pay and what you charge. That's all that is. Anybody can grow as fast as they want in banking, exclusively based on that. You just pay a little bit more on your deposit, so you bring in all that money, and then you just charge a little bit less on your loan, so you can grow. So rapid growth is not in banking is not necessarily a sign of a prudent business decision, or a prudent business strategy. And that's why it's important that we started out at the beginning to understand how banking is different than other industries. Growth for somebody who's a true expert in banking, growth that's incredibly fast, particularly if it's organic growth as opposed to M&A, is incredibly suspicious. Okay. And so if you look at SoFi, okay, so let's just think, okay, so they use all these fancy words to describe what they are. They have the members, you know what I mean? And they have it's a financial technology company where they're going to bring all that kind of stuff. They use but at the end of the day, what is it? If you look at its income statement, 2/3 of its revenue comes from lending and borrowing. Yep. You're just arbitrage, interest rate arbitrage. So it is making money like a bank. 2/3 of its revenue comes from that's your typical bank breakdown, particularly of a bank that size. So it's actually very similar to a bank. So then you say, okay, if this is a balance sheet lender and that's how they make their money, what we need to know is what are they lending money on and how are they attracting their funds? And so if you look at, and you talked about this at the beginning about SoFi started as a monoline, basically student loan lender. Basically, it does probably just to get their foot in the door. And then they've since expanded out beyond that. And what they are principally, they have consumer loans, they do mortgages, a variety of different mortgages, and they still do the student loan and consumer loans and student loans. And so consumer loans are like credit card loans or debt consolidation loans or things like that. Okay. So here's the important thing. So now we know, so that's what they lend on. So now we say, okay, so if you look at different things that banks lend on, like commercial real estate or, C&I as commercial industrial lending, things like that, they all have different curves, right? They experience higher or lower losses in downturn, right? You know what I mean? It's so you want to understand what those curves look like. And so what the curves look like in the context of consumer lending is they're always elevated up higher than other types of loans, right? Because they typically are non-recourse. They're much smaller. The requirement to get them is a lot easier. You're not going in getting a $10 million credit line. You know what I mean? So there's a lot of room. So banks can give a little bit more back and then they charge more on the interest, right? In order to make up for that risk. But the problem with consumer loans is that when things get bad, the consumer, the default rates on those go super duper high. and the loss given default, because you can have default and then recover all that money. But you can have, that's if you're given a 0% loss given default. But if you have like a 50% loss given default, you have a default, you're actually going to lose half of that money. And so in consumer loans are very high loss given default. And so let me give you an example. So your typical bank, like through a tough crisis, like through the 08-09 crisis, like, their non-performing loans will go up to like 1.5% to 2.5% of their total loan portfolio, in and around there. I mean, like they can get up to 4%, 5%, like, but that's really bad. That's a really bad recession and really bad lending leading up to it. But if you go to SoFi's, their investor relations page, and you look at their latest presentation, there's a slide in there that shows their non-performing loans as a percentage, as a function of loan vintage, and compared to a previous vintage that went from the 2017 vintage. And so they show the curve, the loss on the curves of the 2017 vintage, and that peaks at 8%.
Non-performing loans, yep.
Yeah, and mind you, that is not in a steep recession. That's 2017.
Mm-hmm.
Okay, so like, I'm not saying that that it's going to necessarily jack up to 20, 30, 40%, but it could. You know what I mean? Like, that's the type of thing that, like, as an investor, you'd want to get your head around, because when these things go up in smoke, they can go up in smoke. And like this, the general nature and just the general shape of the growth of this company, the qualifications of the person at the very top of this company, and just like, it's just in the environment that we're in. I mean, it's just like, somebody like me looks at it and just thinks like, we don't know how those portfolios are going to perform till they go through this thing. And it could be really ugly, or maybe it'll be great. We don't know, but it could get really ugly.
So I love this conversation, John. There's so much to unpack in that. Let's offer a couple of specifics to kind of unpack what you just said. First and foremost is the person at the top. The person at the top is Anthony Noto, right? This is a guy that's a public figure. He was COO of Twitter back when it was named Twitter, before the X. He was also the CFO of the NFL. He's a guy that understands digital media. He understands social media. He understands very low acquisition costs and engaging behavior that would encourage people to join the platforms like Twitter, like SoFi would. And if you dig deeper in, I'm going to focus on the bull side of this first. I'm going to look at the glasses half full side of this. They have grown incredibly well, probably faster than any other digital bank, at least that's based in the United States. Got their banking charter back in 2022, was the 449th largest U.S. bank in terms of asset base at that time. Within a year, they're up to 114, and within 1 year later, they're up to the 69th largest U.S. bank today. They've got $27 billion in assets after just 2 years. That is phenomenal. And Noto himself has come out and said, my goal is to be a top 10 U.S. bank in terms of asset base. And just to put that into perspective, the number 10, the 10th largest financial institution within the United States is TD Bank, with $370 billion in assets last year. And so at 27 billion, you've got at least 10 to 15x improvement if Noto accomplishes what his stated goal has been.
Well, of course, tell me this, Simon, what was his stated goal?
He wants to be a top 10 U.S. bank in terms of financial assets under management. And so he's at 27 billion. He's got a long way to go, but he's said to a lot of people said he wouldn't even get this far, John. He's done very good on the growth side of the curve so far.
In an environment where all the tide is lifting all the boats, Simon.
Now hold on. Now time out, John. We're going to get to that.
I'm with you. Yeah.
And,
I mean, look, if you look at it from that perspective, that guy knows how to grow something.
And just to be clear, he is getting paid to grow this. And when you look and you dig into the proxy and you say, how is Noto himself being compensated? Again, Charlie Munger was the king of show me the incentive, I'll show you the behavior. He's getting paid for member growth and for product growth, which is what we talked about at the front. And I like the bull side of this. You always say, look how fast SoFi is growing. Look how fast SoFi is growing. He's being incentivized and he's being knocking it out of the park based on his incentive. Now, John, come back in. I'm bringing it back, and we're going to pull off, the rose-tinted glasses, and let's look at the risks associated with that. Because you said in a tough time, when the cycle turns on you, you might have, what do you say, 2 to 3 to 4% non-performing loans.
That's a typical bank.
Mm-hmm. And SoFi, who's going
8% in this 2017 cycle, which was not a deep cycle at all. I don't even think it was a recession.
And unpack this for our listeners. What is the risk that SoFi might be carrying with the balance sheet of so fast of growth right now?
So the problem is that they're sitting on. So let me pull up the numbers. And
Okay, sure. Yep.
Okay, so they grew their loans. Let me pull them up here.
And I'll pull up some numbers too while you're pulling it up, John. They just reported a 0.57% of bad debt expense, non-performing loans past 90 days past due for the personal loans, and then with the student loans only 0.1%. Like you said, it seems like it's very good right now, but there might be some lurking landmines within that.
Okay, so they grew their. Okay, so you can report loans in a couple different ways. Okay, but let's look at their biggest category of loans that they have right now, and those are loans held for sale. Okay, and they have 17 billion of those. Okay, now they also have 9 billion in just typical portfolio loans. Okay, but you look at that growth, and so this is all organic growth. This is not going out and buying another bank. Okay, which is like, that's different. You can double in size in a prudent way with a merger and acquisition. Organic growth is much harder, right? So they went from in their
Can you unpack that a little bit more too, John? When you're buying someone else's assets, they've already been vetted. It's like existing book versus going out and growing it yourself. Is what you're saying? Yeah, the mailers, the direct offers, things like that.
Exactly. Like the typical. Here's a way to think about it. Let's say you start a new bank and you start it in a town, right? And you can then conceptualize a town to a whole economy or a whole country. Okay. Like if you go in and you start making loans, do you think you're going to get the best loans? No, they're already on the books of all the other banks. You're bottom feeding. Okay, unless you have some sort of other model that can like take those books of business over, like a lift out strategy where you lift out a team and it brings its whole book of business from another bank. But that's basically an M&A strategy. You know what I mean? So it's incredibly difficult, like when you start something, to like just grow organically, because like all the loans are kind of already taken care of. You know what I mean? So you look at a SoFi and you think like, so they went from zero in loans held for sale to 6 billion in 2021. So 0 to 6 billion organic. They just lent $6 billion to consumers. Okay. And I'm sure they were the best consumers because that was kind of their first shot. But like, then that grew to 13.6 billion. So doubled, and then went to 15, and now it's 17. I mean, it's like, we talk in like investing, like we talk billions, this, millions, that. Billions is a lot of money. Mm-hmm. You know what I mean? To grow organically a loan portfolio to $13 billion, and then you add the other one, then you're looking at, or 17 billion, you add the other one, you have a loan portfolio of $26 billion that you've grown organically over just a few years. I mean, it's, it's concerning to somebody but like me. But then, in fairness to SoFi, okay, maybe they have cracked the nut on some sort of credit AI thing or whatever it is. I doubt it. Everybody says that we hear that over and over again through time, and it never proves to be the case. But that isn't to say that SoFi won't be an exception this time. Maybe they have figured something out. I guarantee you they hire smart people and pay them a lot of money.
They sure do. And it's interesting because I think that a lot of the investing community is divided on how to value SoFi. You just pointed out that 2/3 of the business truly is just it's a bank. It's a lending business.
It should be valued as a bank. It should be valued as a bank. That thing should be valued as a bank.
Now, how do you value a bank, John? How would you value a bank? We've seen kind of the different sell side reports saying 1 times tangible book value. What would you look for if you were valuing SoFi as a bank?
So when you value banks, you don't necessarily do it with the same metric, depending on where you are in the cycle. Okay, when the cycle is down and all the banks are in trouble, you value them based on book value. And so what you want to do there is you want to pay like 70% of book value, because you're basically buying $1 with 70 cents. Okay, but that's in a down cycle. Okay, in an up cycle, like you can still use book, that's still used. But you want to look more of a kind of a natural normalized earnings cycle in that way. So you just your 12 times earnings, or you do your earnings calculation. You know what I mean? And so your typical bank, if you're just talking book, your typical bank now will trade at 1.1, 1.2 times book. What's SoFi trading at? Do you know?
Let's look it up. Yeah, let's pull it up. What we've got it right here.
Yeah. Let me see here. Here we go. Price to book.
So I believe it's at about 2.47 times book, not tangible book, but just book value on the balance sheet right now.
Yeah,
Yep.
so that's a really high valuation. And the reason it's because they're dressing it up as a technology company. You know what I
Now, do
mean?
you give any this is again, this is a divergence in the convention because some people are saying it's just a bank, value it like a bank. Some people are pointing out the fintech arm of SoFi. And background on this, SoFi is not just lending. They've also got a good portion of the business, which is the Galileo B2C platform, right? So if you are a Wise is working with them. If you are Robinhood, if we're working with, if you want to fund accounts that the business has, it's got an app, you want to have the transactions tracked, you want to do ACH transfer, stuff like that. SoFi can provide the tools to do that, and then you get charged based on a subscription, based on the customer that you have in the size, rather than just the lending that's actually taking place. Does that influence you at all, John? I mean, do you think it's a smaller piece of the business than the lending, but do you think that that makes it not be valued, only like a bank would be out there?
What is JP Morgan? What is Bank of America? What is Citigroup? I
Bank.
mean, like they make SoFi look like an antiquated, like they're chiseling things on tablets.
Yeah,
Do you know what I mean? Like all that's what these companies are now. That's what all these companies are. You know what I mean? So here's the more important reason to think about it in these terms. It's not just for the valuation's sake, okay? It's also because you need to get your mind right. You need to know what you're looking at. You're not looking at a typical company you're not looking at a technology company. You're looking at a thing that's sitting on an enormous amount of credit risk, that's incredibly leveraged, okay? That's going to have to survive a credit cycle. It's the credit cycle that will dictate its success or not its technology platform. And that is why it's so important to understand, like, I would like all your viewers, I would not think about this thing as a technology company. That will get you into trouble at some point. You know what I mean? But right now, with the valuation as high as it is, I mean, some people are buying the line,
It's interesting. It's very interesting to see digital banks and the impact that they've had on kind of how the valuations are thought about these. Obviously software as a service companies, great premium valuations in recent history. The companies like Bank of Internet or SoFi or StoneCo or wherever in the world you might want to be. It has certainly kind of caused some people to second guess how they should be valued. But it sounds to me, John, based on your expertise and how you know this industry very well, we cannot ignore that still the cash cow of this business is from lending, and they've got a very, very high risk profile right now, at least compared to a lot of other banks out there. Yeah.
Yeah, exactly. And like, what they say, like, this is not investing advice. Okay. This is not investing advice. Okay. Well, all I'm saying is that, like, we don't know where this company is going to go. I can't predict the future. Neither can any of your viewers, neither can Noto or anybody else. You know what I mean? But if you know what you're looking at and you know what to watch, that's what investors need to understand. And the thing to watch here is that credit portfolio and what they're doing with that thing, because that's the thing that ultimately dictates the success or failure. Can I bring up one more point, Simon?
Please,
I
yeah,
think
go ahead.
that's interesting.
Yeah, sure.
So innovation in banking, everybody says, oh, bankers are so uninnovative. You know what I mean? Like, we hear that all the time, you know what I mean? From fintech people. And like, I sit down with these fintech people and I say, okay, I will concede your point, sir or ma'am. Tell me about your company. And they say, well, our company has been around for 18 months. I said, well, how much money does your company make? They said, well, we're not profitable yet. And I say, well, turns out, sir or ma'am, that the average bank in this country is 104 years old. And they all, for the most part, make money. And so it's like, anybody who says that these institutions don't know how to innovate is doing it for another reason. And it's probably because they're just trying to stuff their own pockets. Because here's the other thing that people don't understand. When people talk about innovation, they think about like these big leaps. That is actually not at all what innovation is it? If you actually study innovations, what they are a series of stacked incremental improvements that then compound over time. Do you know what I mean? Oftentimes there'll be one final thing, maybe like Steve Jobs' idea. Okay, well, like, we'll have these little tabs. You know what I mean? Like, there'll be one final thing, but innovation is like a very incremental thing. And then what you realize is that when you stack up all of time, like go back to the beginning of the country in the United States, and you look at the financial industry, and you look at, like, you say, like, are things changing faster now than they have ever before? Like everybody tells us they are. What you realize is that no, in fact, they are changing more slowly than perhaps they ever have before. If you just go back and look at history and the pace and the significance of the changes that have happened before, all the stuff that is happening right now is just tiny little incremental changes. And so like when and this is important for investors and bankers to appreciate, when people are running around saying innovate or die, and doing stuff like that, like you can just chill out. You know what I mean? Like innovation happens much more gradually. And so you don't want to hijack your thought process with fear because other people are trying to do that to convince you to give them money for some reason or other. So
There have been plenty of people saying, the banking industry is about to die, or we are disrupting banks. Certainly a well taken. That's harder to do than it might seem.
yeah.
John, kind of closing questions for you. Based on the expertise you have, what are a couple things that investors who want to invest in banking should look for? Are there metrics that you look for as an investor in a bank?
That's a great question. So if you want to invest in banking, you need to, in a responsible way. Okay. You need to understand all the metrics, your profitability metrics, your efficiency metrics, your credit metrics, all those interest rate metrics, all those, you need to understand them. But then you also, after you understand them, you need to forget them all. Okay. And the reason I say that is because a bank's balance sheet, if you were to go into a library and look for a bank's balance sheet, it would not be in the nonfiction section. It would be in the fiction section. Okay. And you have to understand that. You know what I mean? And so then you say, I need to know the person writing this story, because you can make a lot of changes in a story if you're writing it in a fiction story. Do you know what I mean? And so that's when what you realize at the end of the day, what matters is the nature of the person who's leading, who has the ultimate authority to lead this institution, and the context through which they make their decisions. And that context comes from the experiences they've lived along the way. So if you actually care about trying to look forward into the future of a bank, you don't look at the numbers, you look at the people, and you figure that out. You know what I mean? And so that's the big thing that I would say. And then I would say in that context, if you want to understand like the type of bank the type of person that is going to be able to lead an institution that compounds money over time, like banks are able to do, what you ultimately need to ask yourself is this person committed to their fiduciary duty against self-dealing? Because if they aren't, and they are inclined to self-deal, they'll grow the bank faster than it should in order to increase their compensation. And then the cycle will turn, they'll get caught and they'll go down. As opposed to somebody who is abiding by that, they'll throttle their growth when everybody's going crazy. Those people will falter. These people will pick them up for pennies on the dollar. I mean, that is ultimately what it boils down to in banking. Like, does the CEO abide by his or her fiduciary duty against self-dealing? And that's because banking isn't complicated. You do the right thing, you can make money.
Look for sustainability in the bank. Yep, for the future.
Exactly.
Okay, and then John, I read a lot of headlines about banking. Some they're hyperbolic. They're either the world is going to end tomorrow, or it's going to be the best thing in the world tomorrow. 2025. Based on your perspective, what's a responsible prediction that you would make about the banking sector in the next year or two?
Okay, so like we have a mutual friend in Morgan Housel. Do you know what I
Sure,
mean?
yeah, for
I'm
sure.
sure
Yep.
you've read Morgan's latest book, Same as Ever. You know what I mean?
I haven't read the new one. I read the last one though. Yep. Mhm.
Yeah, and he's got another one coming out. He's just finishing it right now, matter of fact. But anyhow, I would say that first of all, I'm not in the business of making predictions. However, you asked for one, Simon. So
I had to. That's the best part, John.
And mine is that it'll be just like it is today.
Yeah.
It might not be, but like that's my best guess.
I love it.
You know what I mean?
And John, before we exit,
although it will be better for banks, because once Trump comes in and reduces those regulations, it is going to be a lot better for banks.
It's going to be. I'm looking forward to seeing interest rates come down a little bit too, not only for me personally, but also for the stock market as well.
And if they really get to work on the regulations in a honest and genuine way, I mean, it could be really good. We could see bank formation. We could see, you know what I mean? It could be a very good thing.
John, before we go, tell us a little bit about the symposiums. I know that you're running these all across the United States right now. I thought they sounded pretty fun and exciting. Can you tell us a little bit about what you're doing?
Yes. So I host a very elite bank CEO symposium, and it's invite only. So I get to invite all the best. I'm doing 7 of them over 7 years. And I did the first one in Philadelphia, and I'm doing it in the 7 major banking cities in the history of the United States. I did Philadelphia the first year, Dallas second year, doing Boston next year. And I create, people will go to a lot of conferences and stuff like that. It is the exact opposite of that, because I actually care about the people who come and pay me, and I actually give them a tremendous amount of value. And that's why I call it a symposium, not a conference. I don't know what a symposium is. I just know it's not the other thing. Do you know what I'm saying? And so I go and I invite these amazing people, and we spend 2 days. I put them in this incredible environment. The first year, I turned this building into an art gallery with 200 pieces of art created from esoteric bank data. This year, I brought them to Dallas. We created a cinematic affair. In Boston, I'm gonna incorporate live performance. It's absurd, but it's the most wonderful thing because the level of trust in it and the quality of these people and what they will let me ask them on stage is so different than anything you'll ever see anywhere else. And so it's just a very special thing. And I appreciate that you asked about it, Simon.
Absolutely. Well, I appreciate that you're redefining what symposium is too, to be what it truly should be. It sounds like a lot of fun out there. John, thanks very much for sharing your insights here with the 7 Investing Podcast this morning.
Sir, it has been my pleasure, and you better have me back, Simon.
I hope to as well. Thank you for joining. For everyone who's listening, John Maxfield is Maxfield on Banks, at Maxfield on Banks on Twitter. I highly recommend following him. And again, invited to the 7 Investing Podcast because, in my opinion, he's one of the most respected and trusted opinions that there is out there when it comes to the banking sector. So I appreciate everybody for listening to this edition of the 7 Investing Podcast. It's our mission to empower you to invest in your future. We are 7 Investing. Have a wonderful week.